All right. Good afternoon, party people. It's your favorite mortgage guy here, Derrick Evans, NMLS 155010. So we got a lot to talk about today. We're going to talk about the Fed minutes. There's some specific information in the Fed minutes that we got to take a look at here. It's a really, really important thing that either the market overlooked today or we're looking at one of the biggest setups of all time. Mortgage rates kind of stay put today on a flat day. Not a lot happening, both in the equity markets and in the bond markets. Very, very quiet day today. Today is very, very quiet. I would call it the calm before what I expect to be a storm. We'll see what happens. I'm going to show you a couple things there. U.S. politicians buying cryptocurrencies, including Bitcoin. And there's an important setup on the Bitcoin chart. We'll take a look at that as well. For people who keep asking me about buying Bitcoin and questions about it, I don't have a coaching service or anything around that. Maybe I will one day. At this moment, I'm a mortgage guy. That's what I do. That's what I focus on, trying to deliver high-level home loans with high-level customer service. But bottom line is, I always try to help however I can. So you can call, text me. First of all, if you if you have a quote from a lender, you want to make sure you got a good deal, call, text me, shoot me the quote. I'll look at it. I'll make sure it looks good. If you have a question about buying or refining, give me a shout. Let's take a look at the Fed minutes. Let me get this stuff off of here. Let me get this out of here. Let me get myself out of here. Okay, so this is where we're going to start. And gosh, you can't understate this. So the Fed comes out, releases minutes. Now, remember, the market started today down. So everything was down today. In fact, we even got a lock alert from Barry today at one point. And I'll show you the mortgage chart in a second. The Fed comes out, releases the minute release conference happens. They talk about everything. They release the minutes. And the market rallies back to zero, basically, for the day. Just kind of erases those losses. Now, what's super interesting about that to me is the specific language in here, because here's the key points. Again, Jeff Cox, probably the best guy over there. Minutes show Fed ready to raise rates. Shrink balance sheet. What? Shrink balance sheet soon. We need to know what that means. Now, it also says again here, Federal Reserve officials outline plans for interest rate hikes and a reduction in the asset holdings on their balance sheet. That's what they mean by shrink balance sheet. That's a tongue twister. And I can tell you right now that, definitely this is no bueno. What they're talking about is the fact that they own about $9 trillion. Think about this. The Fed, which is supposedly just a policy-making, central bank solution, actually owns $9 trillion worth of bonds. They own it. And they're talking about reducing that. So not only, and let's for context, let's look at the chart. This is the damage that has been done in the bond market while the Fed is a buyer. Okay, so while the Fed has been buying huge amounts of bonds have gone down significantly. And these are mortgage bonds. They're pretty close. They trade pretty closely with other bonds too. The whole bond market is pretty much traveling on the same train, okay? Now, so the Fed has been buying these bonds and the prices have still been going down. Okay, while they're buying. Now they're talking about, and this is what I was worried about, and I know if you watch this channel a lot, you've heard me talk about this. This is what I was worried about. If they go from being a buyer to no longer being a buyer, the bond bullies will run the thing over. If they go from being a buyer to being a seller, now they're not just talking about just reducing it. Remember, the taper was we're going to stop buying, but we're going to do it slowly. So instead of buying, we're going to buy $10 billion this month and then $8 billion next month and then $6 billion the month after that and get it down to zero where we're not buying anymore. That's one thing. It's another thing to say, you know what, we got to offload some of the stuff. We got to sell this stuff. No! Because that is absolutely no good for the bond market. Basically just a death warrant. Not even that. A death sentence. May as well be in the chair. So these bonds are going to be under significant attack. Minutes released Wednesday from the January session show concern about inflation and financial stability through members, though members urged a measured approach to tightening monetary policy. So there's concern here, but also concern about how they react. This is a good sign. We want them to be concerned about that. They need to be thinking about that. FOMC members noted that inflation was beginning to spread beyond pandemic-affected sectors and into broader economy. Think about how far they are behind here. At least 10 months. I mean, I am nobody, and I told you we had hyperinflation in April of last year. and it was here, and it was going to be very difficult to get rid of. And now there's just submitting this stuff. What in the world? So mortgage rates, which we're going to go to next here. Let's check out. Today was it was a flat day, 0 basis points. We literally went nowhere today. Nothing happened today. Although we did get the lock alert from Barry, who runs this website, mbshighway.com, because at one point we broke below the support level. See how we're just kind of hugging the support level here? This is extremely, extremely bearish. This looks really, really bad. It's essentially like a bear flag here. You could draw the flag like this. It's the bear flag. It's bad. And there's zero rally ability here. Until late in the day today, where we rallied back up above that support level. That probably was the Fed that pushed that up there. And that support level is right at 100 right now, which is a nice round number. That's the issue rate for the bond initially. And so that's where it's back to. Remember, this thing got all the way up to 105 and something. So these bonds are being destroyed, and the onslaught is going to continue. It's going to be really, really bad. So the most important thing you can take away from that is to lock rates ASAP. As soon as you get your deal in, as soon as you get a quote, I can't tell you how many people in the last 2 weeks have reached out to me, said, hey, want to do a refi? Let me get a quote. They get the quote, and then, every day from then on, the rate goes up. It just becomes less and less attractive. So if you're considering doing the refi, go ahead and get in and get locked. And then if you change your mind, you just cancel it. Just remember that. Like, you don't commit to a refi until multiple days after you have signed your closing documents. So until you've signed your closing documents and multiple days later, you are not committed to your refi. So you have at least 3 business days before the loan funds, and you're committed to it. You can rescind any point in time. So there's no reason not to, if you're considering the refi, get yourself in position, lock your rate, and then if you change your mind, cancel it. But don't sit around and think about whether you want to get started while rates are going up. That's an important key takeaway for today. And let's see here. There's a couple things I want to show you. So let's get to some of this stuff. So outlook for bonds, no bueno. We've known that. We know what the trajectory is. We know like the best case scenario rallies now are like maybe up to here. I mean, I don't even see how we do that. But we're holding on for dear life. Mortgage rates are holding on for dear life right now. So we talked about the Fed, mortgage rates. Let's look at a couple of these stories, and I want to see what we got. So I got the minutes for you if you want to check that out. Lawmakers and their families betting thousands of dollars on crypto. This is an interesting read. Just because, when members of Congress and their families are buying cryptocurrency, it's like built-in protection. A lot of people are concerned that regulation is going to kill crypto and so on and so forth. Now, regulation is going to be a huge business for the government regarding crypto. As we've seen, Russia is a great example of that, where they're not like a pro-crypto country, although people are saying that. No, they're pro-revenue country. They're going to make billions of dollars off of the revenue and taxing these different crypto entities and trades and profits and so forth. And so the United States has the opportunity to do the same, where there's a lot better chance of that happening if actual lawmakers own actual crypto. And so we know the path to $1 million per Bitcoin is going to go through. It can't happen without regulation. So you want regulation if you're a Bitcoin bull. But this one is really interesting. So check this one out. You say, okay, well, hey, usually like lawmakers kind of have an inside track on things. Do they know what's going on? Do they have some sort of, I don't know, but I think it's interesting, and it's definitely helpful. There's this guy here who's actually a governor, so he's not even required, I think, to make these. But there's an interview with him. He plans to make the state of Colorado, so the governor of Colorado plans to make the state a leader in crypto acceptance. And I thought that was really interesting. So you can see different states now seeing it's a revenue opportunity. It's an opportunity to do something positive for your area, to bring in money, to get extra funds, to do different things, to win over constituents. Politicians are seeing that. And so they're sort of flocking to it. I'm going to show you one thing here on the Bitcoin chart, and then I'm just going to kind of get real with you for a minute about what I'm seeing out in the real estate marketplace. So this is what I want to show you. I think this is probably the most important thing right now on the Bitcoin chart, besides, like the macro channel that we're in long term. This is a 1 hour chart. From what I have witnessed personally, in Bitcoin, the most powerful charting patterns that it tends to go higher from are reverse head and shoulders. And right now, check this out. You have a big macro reverse head and shoulders right here. Okay, so sorry, it's not macro. I don't want to say it's macro. You have a bigger reverse head and shoulders right here. Here's one shoulder. Here's the head. Here's the other shoulder, right? This usually means we go higher. Also, what's interesting is the head of this head and shoulder pattern is supported by old resistance back here, which makes that pretty solid. And if you zoom in even further, you can see what's sort of forming here right now is a mini head and shoulder inside of this other head and shoulders. Now, the other thing with this reverse head and shoulders pattern is that typically if the right shoulder is higher than the left, that is the most bullish reverse head and shoulders for Bitcoin. So this is just my own personal observation. Not saying you should do anything with this. Like I said, I don't do Bitcoin consulting or anything like that, but I am following it. I'm tracking it. A lot of people are tracking it. The whole crypto market pretty much moves with this. This would kind of lead me to believe that Bitcoin is going to go higher. We're going to retest this area right here in the next day or two. A couple of things. So we're going to talk. I'm going to get very real here. I've talked to some hedge fund managers. I'm talking to people who are trading the markets, who are very, very good at it. I'm talking to market makers. I'm talking to everybody about, hey, am I crazy? Am I crazy to think that the bond market might just actually implode? That tens of trillions of dollars, the bond market will crash, tens of trillions of dollars will have to go somewhere. Am I crazy? And no one's kind of all the way where I am yet with it, which is fine. But people are seeing that there's definitely issues and inflation is a problem. The money managers that I talked to were not as scarce about investing cash and not as afraid of losing value on cash to inflation as I would be if I were them. But there is definite concern about stocks. We've seen recently that a lot of times when stocks are up, Bitcoin is up. And when stocks go down, Bitcoin kind of stays flat. This is very good for Bitcoin. This is very good, very, very good for Bitcoin. But also when Bitcoin really pumps, it's usually because it's also a tailwind from the stock market. So a lot of these guys are telling me like, hey, you're too early to be bearish. You have to remember how long it takes for these things to play out. And how long will it be before we see stocks capitulate based on tightening from the Fed, crazy valuations, just madness that's going on over there. And most of them say, hey, you're early. You need to wait, pick a better spot. If you wanted to bet against the bond market, how would you do it? The best advice I've got so far is to just short the NASDAQ. And I don't know if I'll be doing that or not. I did short, or I should say I bought a put on NVIDIA today. Just a tip that I got from one of the guys who's like, yeah, this thing's going to roll over. So I did that. We'll see how it plays. I'll talk more about that tomorrow probably or the next day. But stocks could see another leg up, okay? And this is sort of typical. If big money wants to sort of slide out of some of these things, they'll let it run up so they can sell it to you for a higher price. That very well could be the setup that's taking place right now. This isn't even me talking now. I'm just passing this along. Expect higher prices in the stock market in the near future. A lot of people are saying that. A lot of people who are smarter than I am are saying that. But that it will be temporary and that there are issues that are sort of unfixable to save the bull market stocks. There will be pullbacks. We will see a bear market. How bad will it be? Will it be more than 20%? Keep in mind, the NASDAQ is down like 13% from its all-time high right now. They're saying a lot bigger than that, 30, 40, 50%. So I'm just telling you, anything could happen. Anything could happen. But be very careful out there. I'm watching for signs of a bond market collapse. I'm trying to figure out the best way to make money on that. Before the market crashed in 2008, I had no idea how to make money in a down market. I didn't even know you could do that. I didn't know you could bet against stocks. I didn't know anything like that. If I had, I probably wouldn't be here right now making this video for you because I knew it was I knew it was going to happen. I was a part of it. I played a role in it. I was in the mortgage industry. I saw the exceptions, and they would just take any loan. It was crazy. It made no sense. Everyone seemed happy. We were kind of young and dumb, didn't know any better. 14 years later, I know a lot better. And I can tell you right now, we will probably see in the near future, we will see the effect of higher interest rates on real estate market. I don't believe we're going to see it impact San Diego, Southern California, really as much as we will in some other places. If you haven't looked at real estate in other markets, which I look at real estate in other markets all the time, it's crazy to me how undervalued San Diego is in comparison to everything else. I mean, it is crazy to me. Listen, I'm from Middle America. I love Middle America. I will be buying real estate in all sorts of different places in Middle America here moving forward. But the cost to what you get there versus what you get here. Yes, it's a little more expensive here, but you get so much more. So much more. So I still think San Diego, if you look at just comparison to the country, is very undervalued from a real estate perspective. Very undervalued. Compared to LA, still San Francisco, some of these other places, still very undervalued. So I know people think prices are high here. Wait 10 years. Wait 20 years. And then you'll see how high prices are going to get here. But that said, there is going to be a shrinking demand taking place. Interest rates are moving too high too quickly. It's going to get worse. Remember what the Fed minutes said? Just a reminder in case you didn't catch this part of it. They are, so they're talking about interest rate hikes and a reduction in the asset holdings on their balance sheet, which means they're going to sell some of these bonds. So they're not only going to be removing themselves as a buyer of bonds, they're going to become a seller. And that is going to make this chart get real ugly real quick, as if it wasn't already. I mean, look how bad that is. That is really, really ugly. I don't know. I mean, this in itself is like a crash. I mean, just look at that. That's bad. And bonds don't usually move this much, but that's when the manipulation is taking place. This is something that can happen. So I'm advising everyone on the mortgage side of things, whatever you do, and if you need my help, reach out. That's what I'm here for. Okay. Reminder, please don't let yourself get ripped off on your home loan. I mean, if you're trying to refi or buy a home, in just a few minutes, I can tell you if the deal you're getting is a good one or not. I am available. Okay. I'm here to help. People call me and they're like, hey, I watched you on YouTube. Wow, I can't believe you answered the phone. Yes, that's what I do. This is what I do. I study this stuff for my own self and my own investments. I help people, try to help them do the same. And I'm here. So this is what I do all day. Take advantage of me. My cell and email are on the screen. Call, text, email me. Let's make sure you're getting a great deal on your home loan. Whether it's buy, refi, doesn't matter. Doesn't matter. Either way. I had a gentleman reach out to me yesterday. And it was like $9,400, I think, in box A on his loan estimate. My box A is $0 every time. I don't charge any fees. None. And there's a lot of people out there charging a lot of fees. So just be careful out there, okay? Let's expect rates to go higher. Let's expect the market to slow down a little bit. Remember, the best thing that could happen to the real estate market, what's the best? Ask yourself this question on a regular basis. Like, what is the best thing that could happen to the real estate market right now? The best thing that could happen is for it to level off. That'd be the best thing. If real estate prices could level off for a second, and when I buy a second, I mean 6 months, a year. If we could see prices level off, that would really, really, really help for a lot of reasons. Not just because with prices going up and rates going up, we have a sort of an exponential curve in cost, but also because it would help a lot of people who are sellers get off the fence. The reason we don't have any inventory right now is because sellers are kind of looking at their situation and going, well, gosh, we got 2.5% on the current loan, $300,000 in equity. We only owe $500,000 in the place. Now we're going to go buy a place for $1 million and take all of our equity and pour it into that, the higher interest rate. It's hard to do. It's hard to get yourself to do it. You have to really, really want to. It's just, it's a mental block thing. It's difficult. And I understand that. And that's a big part of the inventory problem that we're having right now. We're going to start to see a lot of the stuff is going to take months to flush through. So a lot of things I'm telling you about today, you're going to be like, oh, he was wrong a month from now. 6 months from now, you'll be like, okay, he was right. So it's going to take time. So we're way ahead of the game. So plenty of time to make plans about what we want to do here. We don't need to FOMO into anything. We don't need to FOMO out of anything. If you want to trim down your stock investments, you can do it slowly. You can shave off on up days, or you can, take 50% off the table and then plan on scaling it back in over the course of 2 years or something. That's not a bad strategy if you believe what I believe, that's, stocks are going to be under heavy selling pressure here in the near future. But where's all this money going to go? Where's all this bond market money going to go? Where's all this tens of trillions of dollars going to go that is currently net negative to inflation with risk? Where is that money going to go? A lot of people were telling me, well, it's going to go to real estate. I don't think so. I don't think that's where it's going to go, because that money could already easily be in real estate. Remember, bond money is supposedly safe money. This is like, bonds are sort of like the savings account in the stock market. Think about it that way. And if the savings account all of a sudden is paying you zero, notice also, by the way, how the banks have conditioned us to believe that you should get zero, essentially zero for your money. No APY. You realize how they condition us for that? They've conditioned us to believe that we should have a savings and a checking account, even though neither one of them pays us anything. That we should give them our money, even though they don't give us anything for it. Isn't that crazy? That has happened over the course of the last decade, and it is mind-boggling. So a real savings account pays you money. When there isn't a way to get yield in that fashion, then bonds are the first stop, okay? Safe for the most part, right? Safer than stocks for sure. There is some risk, but it's smaller, much smaller, and very rarely comes into play. You get some yield, so you can count on some money. You also could get appreciation. You could buy these bonds here at 100, and they could go to 102, and you could sell them. Make your 2% right there. That could happen in a week. Instead of waiting a whole year to get your 2%, you could get it in a week. And you can move on. You can buy another bond. So you can trade. There's a lot of cool things you can do with bonds. The problem is now they're pieces of paper with small yield, and there's extreme inflation, so they're worthless. Just like that. Isn't that crazy? It seems like it's just like that. This took years and years to build up, and now this is where we are. So these bonds are worthless. I suggest looking at your investments and seeing how much bond exposure do you have. People will be like, well, I don't own any bonds. Check your mutual funds. Check them. What kind of bond exposure do you have? You may notice if you have a mutual fund that's underperforming the market, it could be because they have 5 or 10% or 20% allocation to bonds. That's totally possible. Bonds have been getting slammed. So bonds are going to get murdered, rates going up, and that's going to kind of slow things down a little bit. At what point will people think it's a good deal to buy these bonds again? Is it going to be at the quoted inflation rate, 7%-ish? Could be. Is it going to be 10%? Is it going to be 5%? My guess is probably 4 or 5%. But I could be wrong. I could definitely be wrong. And will just this sort of like, think about this. When COVID hit, we already had all of the technology needed to make it. We had Zoom. We had video conferencing. We had, the ability to work from home and call people from our cell phones and, do emails. And we already had everything we need to survive. But because of COVID, it sort of pushed all this stuff forward. It really catapulted all those things into mainstream. It's very possible, and it is my prediction, this potential bond market collapse will do that exact same thing for crypto. It will rush the adoption phase through, because the bond market will sort of not disappear, but it will not become a desired thing for investors. Right now, there's still a lot of investors. Remember, 75% of the wealth is owned by people 65 and older. So there's a whole transfer of wealth that's going to be taking place over the next 10 to 20 years anyway. But from the standpoint of just in general, people wanting exposure to bonds, your returns are going to look terrible, especially in comparison to what's taken place in the money that's been made in other investments. So will it catapult crypto forward, Bitcoin forward? Some of the DeFi projects out there I've told you about, where you can make 8, 10, 12% APY on your coins. It seems to be a better bet than bonds as far as making your money, but again, it comes with a little bit greater risk. And now we're seeing what some of the risks are to bonds that a lot of people were, I think, unaware of. There was one more story I wanted to show you. Let me get myself out the way. Yo. We are live here if you want to say hi. Ask a question, drop some knowledge. It's all free game here. The average size of a new mortgage just set a record as home prices continue to climb. So the average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances increased to 4.05%. So this is interesting. Let's have some fun. Let's have some fun. Here, let's go over here. Conforming balances, she says. So let's do it. And she's talking about conventional loans. This is Diana Olick. Don't like her. Don't like her one bit. But is what it is. She covers real estate for CNBC, so see her a lot. Average purchase loan size was $453. Applications to refinance a home loan are now less than half of the volume a year ago. So apps for refis down 50%. Average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances, so that's under $647,200, increased to 4.05. So that's the average, 4.05. Let's see where we're at here. Conforming balance. So let's just call it like a $700,000 purchase price, right? Because we're going to keep it under the 647. Let's see where we're at today. We'll call it 640. Okay, what is that? Yeah, a little bit more than 5% down. We're going to do, we always use 780 for credit. This gives us a top tier rate. Single family, no fees, no points. No whammies, no whammies, no whammies, and stop. All right, so we got options here. So, and this is what I was talking about. So the first par rate option, 3.99%, right? So 3.99%, that gets you a lender credit of $21.95. Now, however, it's only $1,000 to get 3.874. And so that's going to be worth it, right? When you look at the payment difference, $3,055 versus $3,009 in this example, it's what, $46? So $46 to $1,062. This is how we figure out if it's worth it or not. 1062 divided by 46. Takes you less than 2 years to break even on that, so no brainer. If it's less than 4 years for the buy down, I think it's a no brainer to pull it, to go ahead and go for it. Most of these won't be that way though. Most of them will be a lot more than that. The further you go up or down the rate sheet, the lower you go down the rate sheet, I guess I should say, the more it doesn't make sense to pay the points, and the more time you need in the home. And you think about it, you need time to catch up to get to break even, and then you need time to actually have that investment make money for you. So, if it's under 4 years, I think it's a go. Outside of that, for me, it's a no-go, but you can do whatever you want, of course. You can see the APRs are over here. So 3.874 does have some points. I wonder if so that's one thing that's interesting about this data, and I didn't think it would be disclosed there. They don't tell you what the points and fees are. So notice that they're saying, hey, rate increased to 4.05. And by the way, this is last week's rates, and I can tell you rates are up since last week. So last week's rates, which rates are higher now, 4.05, and that's just across the board. So it doesn't include lender fees or points that people paid. And here we are today, a week later, rates are up, and if you want to just do apples to apples, it's hard to say what points and fees other people are charging and whatnot. But our no point, no fee rate is 3.99. And that's with a $2,200 lender credit. So no fees, plus you get $2,200 towards closing costs. So I always like testing. I had not looked this up beforehand. That's how much confidence I have in looking at my rates, is that we're going to beat things like this, no problem. But we also don't charge any of the fees or the points, and I think that's also a big deal. So just to recap, Fed minutes talking about being a bond seller, not only tapering but selling bonds, offloading bonds, lawmakers getting heavily involved in the cryptocurrency industry, mortgage size breaking record, rates going up. We basically have a bond market catastrophe waiting to happen. And I really, really hope I'm wrong about it. I hope something saves it. I don't know what can, though. I think the ship has sailed. And I'm looking at ways to make money in a down market. So I'll be sharing that stuff with you as I come up with it. So far, The best thing we came up with this week with all the fund managers I talked to, I basically just called them and said, hey, listen, here's what I think is going to happen. How should I place my bets on this? Like, how would you make money off this if you believed what I believe? So I didn't ask for their opinions, but I said, this is what I think is going to happen. How would I make money on this? And so far, I haven't gotten a great answer, because how do you play a bond market collapse? The only bond market collapse that we've seen really in real time was the real estate collapse, the Great Recession, they called it, 2008. That was a bond collapse. It was a bond market collapse, complicated one, but propagated by Wall Street and the payoff of ratings agencies to label complete dog crap bonds as AAA and sell them to the whole world. That's a very different situation than what we have now. This is an inflation bond collapse. So this is going to be a bond collapse that is caused by inflation, in my opinion. And if I am right about it, what's going to happen? We've not seen this before. So will rates just go up and bonds will be fine? Will mortgage rates just go to 6, 7, 8% and everything stay the same and be fine? That would change the game, wouldn't it? What would happen? And so ask yourself this. Okay, so if rates just went up and that's it, and the bond market stayed intact and all $120 trillion stayed there, then what would happen? Well, if mortgage rates went up to 6, 7, or 8%, that would definitely impact real estate values. If CDs and savings accounts rates went to 6, 7, 8%, that would definitely impact the amount of money that's invested in the stock market, wouldn't it? So if the bond market lives through this and yields just go up to meet demand naturally, without any stimulus, without a straw buyer, the Fed, the Fed is like the biggest straw buyer of all time. They really are. Except for they actually do it. They actually buy. But they're also there as a straw man to basically say, hey, we're going to buy it if you don't. Right? And they do. So if the bond market does that, then you're going to see stock market and real estate really take a hit. I don't know how bad, but it'd be pretty significant, don't you think? I mean, if we're coming off of 3-something% interest rates and interest rates doubled, that would definitely cause a problem, especially depending upon how long it takes. That's the thing. I think the velocity of this is what's dangerous about it. It could happen very quickly. This could happen in a month. We could go from 4% mortgages to 6% mortgages. That would be a problem. So I've been watching, tracking. It's the reason I've been updating you. I want you to know where this is at and what's likely to happen next. So in that case, the advice I got from several money managers was right. Like, yeah, short the NASDAQ. That one's got the highest PE. If stocks fall altogether, that one will fall the hardest. And if bond rates go up that much, then stocks should fall. So those are the traits I'm looking at. Those are the things I'm thinking about right here. Because it's going to be, winter is coming. I mean, winter is here in the mortgage industry. It definitely is. I've got time. If you need me, let me know. And, the reality is the financial markets are really trying to find themselves, and they're going to have to do that sans Fed. So now imagine you have, think about the Fed as like, no, I won't use that analogy. Think about the Fed as like being the cool person at the party. That one person that everybody likes and is so happy that they're there. But when that person leaves the party just doesn't seem cool anymore. The party's just got a lot less cool. That's what's happening. The party's about to get a lot less cool. And I cannot explain what happened today with the late day rally, but I'm extremely intrigued to see what happens tomorrow. So hopefully this is helpful. Let's see. Let me get myself out of here. If you have questions, I'm here. That's what I'm here for. Here to help. So let me know if I can help you in any way, and I will see you guys soon. Have a great day.